ARK Invest is down 50% from its 2021 highs, prompting many investors to sell the fund. ARK's flagship product, ARKK, has shrunk from $27 billion under management at its peak to $12 billion today. The trend has changed, and now that the price has dropped significantly, investors are even afraid to touch any of the ARK ETFs, and many are shorting them. This is counterintuitive, as lower prices often correspond to higher expected future profits. The CEO of ARK Invest, Cathie Wood, believes we are at a price point that presents one of the greatest opportunities in the history of the entire stock market. The biggest concern of most people regarding ARK's portfolio is that it's filled with growth companies, and with all that's going on, the Fed hiking interest rates to combat inflation and fears of a looming Russo-Ukrainian conflict. Markets and people are both expecting growth companies to underperform for the next decade. While historically this may be even true during the First and Second World War, things are not the same today. The pace of innovation, for instance, is much faster now than it was in the early 1900s. The Federal Reserve didn't exist back then. Neither did the ability to stimulate the economy using quantitative easing or shrink the money supply using quantitative tightening. These tools allow us to get out of recessions quicker and help keep the economy stable. Regarding interest rates, many economists believe that the Fed will raise interest rates more than 25 basis points. They're now predicting a 50 basis point hike in March. The higher the Fed hikes interest rates, the sooner it will be able to combat inflation. This is good for the stock market, as when we get more clarity, the stock market will likely stabilize.
The supply chain issues have lasted so much longer than we anticipated that they would take a while to work out, but not 2 years. So the question is this supply chain related? And will these inflation metrics unwind? I think a lot of what's going on is supply chain related. I know it's become unfashionable to use the word transitory, and so we won't, because it's lasted longer than we expected. However, I do think there's going to that the deflationary forces that are building up in the economy today are pretty strong. Two are secular, one is cyclical. And the bond market is sort of getting this. If you look at what's happened to the yield curve, so the difference between long rates and short rates, it has flattened from, I think, 155 basis points last March to 45 basis points today. And if the Fed did go 50 basis points in March, which they might, I think that it would be one and done then, we'll end up with an inverted yield curve. And then what are people going to think? Well, an inverted yield curve and the flattening yield curve says, watch out. Something's going on here. Either growth is going to disappoint or inflation is going to be much lower than expected, or both. And we think both is right. And so that's the cyclical source. There's an inventory buildup. If you look at the record-breaking inventory buildup in the fourth quarter GDP report, you'll get a sense, while inventory to sales ratios might be low, as the consumer switches off here. And if you look at the last 3 months of either retail sales or consumption, the consumer has gone pretty flat. Meanwhile, you've got the double ordering and triple ordering by manufacturers and wholesalers because they were missing sales before. So I think there's a big inventory problem brewing here, and it's going to hit within the next 6 months in terms of that recognition. That's the cyclical side of inflation. The secular side has to do with innovation.
Coming to Cathie's argument and rationale on all this, she believes that higher inflation won't impact hyper-growth companies as it would to large tech companies. This is because the impact of inflationary discount on hyper-growth companies will be less, since they grow at a very fast pace compared to large tech stocks growing at a slower pace. This leads her to believe that the hyper-growth companies in her portfolio are undervalued right now. Apart from these, Cathie's investment firm ARK Invest focuses on the long term. So, despite her stock picks getting beaten down in the short term due to uncertainty, their long-term forecast should still hold. The thesis being, a 10% slowdown in growth will impact a large company with a growth rate of 15 to 20% more than a small company growing at 40 to 50%. ARK Invest is making a huge bet on genomic revolution and DNA sequencing to cure diseases in the healthcare sector. Cathie believes that these companies are in a perfect position to capitalize on this biotechnology revolution. As people have more money in their hands, they're going to want to live longer and healthier than their predecessors. This makes any breakthrough in the field of curing previously incurable diseases like sickle cell anemia a win-win for both the companies doing it and people who are suffering from them.
So our focus is understanding cost declines associated with technology and when costs are going to drop low enough so that demand in different sectors will pick up. Just give you a few examples. So for every cumulative doubling in the number of whole human genome sequenced in the world today, costs drop, the cost of sequencing drops 40% if you're Illumina, 28% if you're a PacBio on the long read side. Robotics, for every cumulative doubling in industrial robots, cost decline 50%. We have major labor shortages. So that cost decline will cause increased adoption and will lower the risk associated with wage inflation continuing. And then artificial intelligence costs, I gave that one, down 60% per year if you include both hardware and software. These are major, major deflationary undercurrents. The other side of disruptive innovation is creative destruction. And what does that mean? It means the existing world order, the traditional world order, is going to face disintermediation and perhaps destruction. And we certainly see this in everything transportation. In retail, there's still a lot of creative destruction taking place.
Right.
In the healthcare space, right? So what's going to happen is these companies whose products are either going obsolete or who have not invested enough to update them, they are going to have to cut prices. So we see major deflationary forces, and I think the bond market is on to this. If I didn't see some signal supporting what we're saying in the marketplace, like that yield curve, I'd probably say, gosh, I don't know how long this is going to last. But I have a feeling these deflationary forces have entered the bond market cycle.
It's already happening. People are already living longer than before, thanks to advancements in medical science, and this will only get better in the future. Then there is artificial intelligence and its rapid adoption in various sectors like automobile, finance, space exploration, food, and healthcare. Cathie believes that with rising adoption of artificial intelligence in various sectors across the globe, we will see a massive growth in the world economy. She thinks that we are still at the early stages of the S-curve growth trajectory that artificial intelligence will enable us to achieve in the next few decades. What do you guys think about Cathie Wood and her fund ARK Invest? Don't forget to tell us in the comments section. Thanks a ton for watching. We'll see you in the next one.